Stocks keep dropping, and you are gonna hear people say, buy the dip, buy the dip. What? Buy what dip? This thing keeps dipping. The stock market keeps falling. So I'm buying the dip today, and it keeps dipping tomorrow. And I'm actually not buying the dip. I'm throwing my money away by investing in the stock market right now. I'm catching that falling knife. Hey guys, it's Aman from Our Rich Journey, and on today's video, I am gonna help you guys with this issue because a lot of you guys are seeing the stock market go down and you are hearing talking heads on these news networks talking about buy the dip when you are probably sitting at home thinking, well, what does that really mean? So buying the dip is an investment strategy where you purchase stocks after their prices have dropped, hoping they'll recover and go even higher in the future. The logic is simple. If a stock was worth $100 yesterday, but now it's $80 today, you might see this as a discounted buying opportunity, and so you are buying the dip. But here's the catch. How do you know if this dip is temporary and is a buying opportunity or just the start of an even bigger drop? What if you buy now and it falls another 10%, another 20%? What do? That's why buying the dip blindly is risky. Instead, you need a strategy, a structured way to enter the stock market that doesn't rely on guessing the bottom. So on today's video, to help you devise your own strategy, I'm going to talk about 4 strategies to help you safely buy the dip and an additional strategy which we use, which we think is the ultimate way to invest in the stock market in a situation like this. So let's start with the numbers. How bad is the stock market right now? Since the stock market peaked in January of 2025, the S&P 500 is down more than 10%. The Nasdaq is down almost 15%. And when you look at individual stocks, Tesla is down over 50%, losing $700 billion in its value. And some of the other tech heavyweights, the fan favorites like NVIDIA is down almost 25%. Meta is down over 20%. Apple down almost 20%. Amazon, 20%. Microsoft, 20%. All these tech heavyweights that make up a huge part of the stock market are down more than 20%. Now these numbers are ugly, but is this the bottom? It could or it couldn't be. We have seen the stock market fall a lot more in the past. So how do you invest in this type of market? Well, this brings us to the strategies that advanced investors use when they are investing at a time like this. The first one is the percentage-based buying strategy, where you buy every X% drop. In other words, instead of guessing the bottom, this strategy involves buying a set amount every time the market drops by a certain percentage. For example, if the S&P 500 is down 5%, you buy a small portion. If it drops another 5%, you buy another small portion. If it falls another 5%, you increase your purchases. This approach helps you take advantage of falling prices without going all in too early. If the market rebounds sooner than expected, you've still built a position. The next strategy is the moving average strategy. Rather than relying on emotions, this strategy uses technical indicators like the 200-day moving average to decide when to invest in the stock market. So if a stock or an index falls below its long-term moving average, it signals a possible buy opportunity. This method helps you filter out short-term noise, and it gives a data-driven approach to buying the dips. Many professional investors watch these moving averages closely to determine whether a market is oversold or if a deeper decline is underway. The next approach is called the staggered buy-in approach. With this approach, you break up your investments into smaller bites over time. So let's say you have $10,000 to invest. Instead of investing it all at once, you put in $2,500 now while the market is down. If it drops further, you invest another $2,500 in a month, and you repeat this process giving yourself flexibility if the market continues to fall. This way, if the market recovers quickly, you are already invested. But if it keeps falling, you still have cash to take advantage of even better prices. The next approach is what I like to call the fundamental value buy-in, where you are only buying quality companies that are experiencing a temporary dip. This is what Warren Buffett likes to call value investing. And so let's face it, not all stocks are going to recover. Some will never bounce back. And it is a time like this when companies are being more scrutinized that this becomes more apparent. The companies that are built completely off of speculation, when investors start to look at the fundamentals and the financials of those companies, they realize that these companies are built on a house of cards. But investors that are looking at companies and they are finding companies with strong balance sheets, these companies are the types of companies that you want to invest in at a time like this. You see, this strategy focuses on buying great businesses at a discount rather than buying just because a stock is down. So you want to do this by doing 3 things before you consider buying a stock. The first is look for companies with strong earnings, low debt, and competitive advantages. The second is avoid companies that are struggling with fundamental business problems. Third, focus on sectors that are likely to rebound strongly when the stock market recovers. For example, if Apple or NVIDIA falls 20%, but their core businesses are still strong, that could be a buying opportunity. But if a company's fundamentals are crumbling, the dip might not recover. I think Tesla is a prime example of a company that has fundamentally changed. It is a company that at one time had a great advantage in the market, but with increased competition, with sentiment surrounding the product changing significantly, will Tesla recover? It's down right now about 50%. And they are not selling a lot of cars like they used to. So this company is going to be struggling to recover. Now, all of these strategies that we have talked about, there is one strategy that is kind of floating around all of these. And it's the one that we like to use when we invest in the stock market. It's the same one that we have used our entire investment career. We have a strategy that involves dollar cost averaging and lump summing. You see, our idea is to invest in the stock market sooner rather than later. So whenever we have a large amount of money that is available to invest in the stock market, we usually invest it sooner rather than later by lump summing it into the market. But whenever we are receiving income on a weekly or a monthly basis, we invest that money by dollar cost averaging it into the market. You see, at a time like this, where there is a lot of volatility, people get nervous. First of all, let's face the bottom line. No one can predict the direction of the market in the short term. But historically, we have seen the stock market always recover and go higher. My advice to you is you should do whatever you feel comfortable with. But keep in mind that you will be very anxious if you are watching your portfolio at a time like this. And so if you do have a large sum of money and you are interested in investing in the market right now as a lump sum rather than dollar cost averaging, then my recommendation is to do it and walk away. Don't think about it anymore, because most people fail at lump sum investing because of the anxiety involved in it. They think they have a high risk tolerance, and so they say, I have $10,000, I'm going to put that $10,000 in the stock market, but when they see that $10,000 go to 9 to 8, they get nervous, pull it out, and they've lost money because they didn't stay the course. They didn't stay in as a long-term investor. But a long-term investor can feel completely comfortable lump summing $10,000 in the market and watching it fall all the way to $5,000 because they know over the long term that money is going to recover and go higher. And so if you are a person that will be anxious about seeing a large sum of money that you put in the stock market go up and down, then lump summing is probably not for you. You are probably better off with one of these other 4 strategies that are a take on dollar cost averaging. And dollar cost averaging is a great way to invest in the stock market because you are investing a fixed amount of money every week, every month, whether the market is up or down. It really smooths out the purchase price over time, avoiding emotional investing. And it also ensures you're always taking advantage of market declines without panic selling or timing mistakes. History has proven that staying in the market is more important than timing the market. Since 1926, the S&P 500 has recovered from every single bear market, eventually hitting new highs. So the bottom line, instead of waiting for the perfect moment to invest in the stock market, focus on consistency, keep investing, stay disciplined, and let time do the work. I hope that this video has given you guys food for thought when you are developing your investment strategy at a time like this. And so if you like this video, please give it a thumbs up, subscribe to our channel, and join the journey.